We got a big bang announcement from the government on Friday with corporate tax cuts being announced, sparking off a rally in the equity markets, although slumping the bond markets. Now, you can look at the announcement through various lenses. You can look at it from the lens of reform, or you can look at it through the lens of stimulus. You can look at it through a long-term lens or a short-term lens. Joining us to share his perspective is Neelkanth Mishra, Managing Director of Equity Research at Credit Suisse. Neelkanth, thanks so much for joining us here on Bloomberg Quint. Let me first ask you for a big picture view. I see from your note that you're fairly optimistic and you see this as the start of meaningful reform. Do you want to detail your big picture view first?
Yeah, so this shows, see, so far we've been just waiting for the government to feel that there was something very meaningful and large which was necessary, and this clearly is this reflects that the government now sees this as a very serious problem which needs some large and structural changes. So I suspect this is not the first one. So if the government has realized that we need, because any economic framework I think needs many changes, not just one, and therefore I think this is just the start of the process. I view it from two different, let's say three different approaches. The first is that India lacks risk capital, right? At this stage of per capita GDP, the nature of savings is mostly in deposits or a very fragmented equity. There is not too much of aggregated equity which is available. So if you need, for example, in the example I used in the note that you're talking about, if you need 50 million tons of steel capacity and 200 gigawatts of power capacity, you need at least $100 billion of equity. Now, where will that come from? And aggregating it through the stock markets, because the SIPs, etc., are doing well, is not sufficient. Now, what the government has done effectively, so this shortage of risk capital is something that other emerging markets at this stage have done it through exactly what we decided not to do, which is socialize the losses and privatize the gains. So in China, for example, the banks give a lot of loans. The loans that work create billionaires. The loans that don't work, then the losses get spread out over all the depositors who are paying 2% interest rate or getting 2% interest rate on the deposits. Now, this is something that we've decided not to do. So where will the equity come from? And the government has more or less decided, see if you reduce the tax rate, you're leaving 10% extra with the corporates, and this is very important for equity generation. So that's the first thing. The second thing is that this attracts significant FDI. Now, in the last 20 years, every country in the world has cut corporate tax rates. In the last 20 years, everyone has moved to a 20 to 25% bracket. We were the outliers sitting at 35%. So this is a very meaningful change. What this means is that the intent is to attract foreign capital, which is very important for the risk capital generation that I was talking about. Most people don't know that almost 40% of Chinese exports are from foreign-owned firms. And it's very important to attract that kind of capital, and this tax rate, I think, does that. The 15% tax rate for new businesses, new companies, is a reaction to what's been happening in Southeast Asia, that as companies start to explore moving out of China, countries are competing to attract them, and this is a very welcome reaction to that the government means business. The third aspect is that you have say 145,000 crores, 1,45,000 crores, 1.45 trillion rupees. Either the government spends it or the companies spend it, right? So it's just a transfer. It is a lack of a transfer now. Now, the government, in terms of capital formation, I think has kind of run out of ideas. So how many more highways can you plan and build? As we are seeing, they're starting to see that at the current pace of growth, at the current level of GDP, some of those roads may not be viable. The railways, though there is enormous capacity to invest, or the potential to invest, the ability to spend faster than 1.6 trillion rupees a year, which is several times what we did 6 years back, but still, that's not big enough. So what will the government do with this? and therefore it is much better to leave it with the corporates. And I don't think this will get invested very quickly, because the companies that are deleveraging will accelerate the deleveraging. The companies that are sitting on surpluses anyway had no avenue to invest, so they're not investing. But over the medium term, this allows for the equity capital to accumulate, on which the companies can build their investment case, even if it is 2 to 3 years down the line, so that we do not have the pyramid cases that we had in the last cycle, where people borrowed at the parent level and made that equity at a subsidiary level. So when even at the whiff of a downturn, the whole house of cards collapsed. Now, that kind of situation can be prevented if you allow this equity to accumulate in the companies. And the most obvious impact of that is in the banks, where the fast-growing banks every few years need external capital. I think the necessity of that goes down significantly because of this.
Okay, so let me ask you this. So, I think over the last maybe 6-8 weeks, when sentiment had soured quite meaningfully, the question was that do we now have to go to fiscal stimulus? Now, if this announcement is coming from a place of worry about the current economic situation, then it probably doesn't do very much, right? Because you could have taken that same 1.45 lakh crore and chosen to use it in a way which had more direct impact on the economy, such as a consumption stimulus. But you haven't chosen to do that. So the current economic situation does not really get addressed because of this, by this?
What it does do is, at the margin, change sentiment. There was this belief among many people that this government was kind of, anti-rich or anti-corporate, didn't believe that corporates were necessary and all that. This changes that view. At the margin, it will, I think, perhaps encourage some people to be slightly more forthcoming. But this is consistent with the government's view, or the government's stance so far, that we need to prioritize investment over consumption, right? So the objective is to bring down interest rates, because at the margin, so if we all assume that this 1.45 lakh crores is all going to add up to the bond issuance by state and central governments. If you think about the arithmetic, about 84,000 crores, 840 billion rupees comes to the cost will be borne by the center, 58% of this. 42%, which is about 600 billion or 60,000 crores, goes to the states. Given that the states mostly can't breach the 3% fiscal deficit target, they'll have to cut expenditure. To the extent that, as RBI reported, the aggregate fiscal deficit target was about 2.4%. Maybe there'll be slightly more fiscal deficit in some states. But this largely means that they'll have to curtail expenditure somewhere. Similarly, at the central level, this the PM Kisan, the budgeted number is 85,000 crores, but as you must have seen, the governments at the state level seem to be struggling to identify these farmers. So instead of the 14 crore farmers that the center identified, they seem to be able to find only 7 crore farmers, and therefore that's running at about half the pace at which it should. That's a 40,000 crore saving. So that's like and the remaining 40,000 crores could also come from some curtailment of expenditure. Even if it doesn't, that's a very small cost to pay. So what the government seems to be prioritizing is, again, investment over consumption. And I don't think the government is as worried as markets and companies are about the next 6 months of growth. I think they're taking it to the long haul. They realize that the fiscal discipline that they observe and the very hard focus on inflation that we have seen from this government over the last 5-6 years should result in much lower interest rates. And I'm sure you'll have questions on the bond yields after this, but should result in lower interest rates. And therefore, this is very good for the economy if you're thinking 3-5 years out. And this actually would put to rest any further speculation on a fiscal stimulus. So this clearly shows that no consumption stimulus is coming, and so the government may be willing to just ride through this down cycle, and therefore it can get quite worse. And that, to answer the question on the interest rate before you even ask it, that if this had been a consumption stimulus, it would have been even more of a risk to interest rates, and that is the risk of raising interest rates, because if it is just pure consumption stimulus, it would be at the margin inflationary, especially if it is funded by RBI's open market purchases of bonds. Whereas something that adds to capacity, potentially, I mean, and that too not in the near term but 2 years out, and is actually the cuts are funded by curtailment of expenditure at the state level and potentially at the central level as well, is actually negative for inflation, and therefore the immediate reaction in the bond market notwithstanding, this should mean lower interest rates a year out.
Okay, I'll talk about interest rates in a minute, but I do want to ask you what you think sort of the dominant corporate behavior post this will be. Will the tendency be largely to deleverage a little quicker? So as in when you get to a point where demand picks up, capacity utilization goes to 80-odd%, you could then see a far quicker uptick in private capex?
That's what I think is likely to happen. So if you, it's very hard to talk about all the 1.45 lakh crores. So let's look at the microcosm of that, the BSE 500, right? So the BSE 500 together in FY19 paid about 2.3 lakh crores, right? About 34% of the 6.7 lakh crores of total taxes that were paid by corporate India in the last year. So about 34% was paid by BSE 500. 2/3 of this was energy, financials, and materials, which is metals and cement. So while the consumption companies, which is durables and staples, which together are I think about 7-8%, maybe 10% of this number, they could respond because of competitive dynamics by passing it through, meaning use this as a stimulus either to generate demand by advertising or just cut prices given competitive dynamics. In some cases, as my colleague highlighted, and it's a very wonderful insight, that there are some companies in consumer categories which are on MAT. There are some companies that are paying 35%, say in toothpaste, and so the company paying 35% now has much more ammunition to fight the ones that were on MAT. So those things will happen, but by and large, 2/3 of this BSE 500 number is actually in energy, financials, and materials. Now, in materials and energy, I don't expect any fresh catalyst. I mean, if cement is in oversupply, it is in oversupply. There's no need to build up cement capacity. And for steel companies, again, given the global environment that it is, it may be prudent to actually deleverage, given that all of these companies have acquired assets. There's been industry consolidation. So that's what I expect. Therefore, I don't expect this to be invested immediately. On the financial side, this helps. So what it does is it allows for better accretion of tier 1 capital, and therefore slightly better lending intentions in the coming year. So contrary to the fears I've heard from some investors that all of this will be like in the US, the corporate tax cuts were either the employees got hikes or buybacks happened, or this was passed on to consumers, and therefore what was a corporate stimulus became a consumption stimulus. I think this will be very different. It may show up with a lag, but it will not be a consumption stimulus.
Okay. Now on to the bond markets, sir. You already answered the question on interest rates and what you think the impact on policy rates may be. But if you saw the reaction on Friday in the bond markets, the issue of term premia and credit risk that you have spoken about for very long, that doesn't look like it's going away anytime soon. So, well, really, interest rates will actually perhaps go up, or at least not come down for a large number of corporates.
I know. You're absolutely right. I think so if you see the OIS market, it's effectively already pricing in a 50 basis point cut from what I last saw, so 4.9%. So on that, a 6.8% bond yield means a 190 basis point term premium, which is astounding. In an environment where the RBI is actually buying 2-3 lakh crores of bonds, and the government has yet not talked about a fiscal slippage. So, and after this stimulus, given that we all know what is, well, we can guess on how this will be funded, and so on and so forth, and how medium-term positive it is for ratings, for weird reasons, the bond market decides to sell off. My sense is, and there are disagreements on this, that this term premium is less about the fiscal slippage and the crowding out, because the India's the economy or the capital account is closed to a large extent, but it's not that we're just sort of dipping into the in the domestic savings. There's a lot of capital that can come in from outside as well. So it's wrong to think about crowding out and the PSBR, the public sector borrowing requirements, etc. My sense is that it is a signaling problem, as we've often discussed on your show, that the MPC has erred in saying, okay, we're cutting by 25, but this is it. We're cutting by 25, but this is it. Given that 45% of the bond market is, of the bond ownership is with PSU banks, with the Treasury departments, sad to say, is not really driven by profit motive and it's actually quite lethargic. I would say that, and this is not to criticize the market is the market. We need to learn how to navigate through it, and also, if you're a policymaker, guide it. And my sense is that as the guidance improves, in the sense that, okay, so let me take a step back, and a framework which I have used and which perhaps is useful revisiting, is worth revisiting, is interest rates that a borrower sees consists of four parts. The first is inflation. Second is real repo rate. So this is the repo rate, the short-term risk-free rate. Third part is the term premium. So repo rate plus term premium is the 10-year bond yield, right? So this is the third part. Add to that the credit spread. This is the bond market equivalent. You can create a parallel one for the banks as well. Now, inflation has come down, and this is something that I have long believed is the crux of the problem, that our inflation is half of what it was averaging over the past 6 decades. The last 4 years is the 3.8, the last 60 years was 7.5, and neither the government nor the corporates have adjusted to it. So the corporates thought that inflation would take away their debt burden, or rather reduce their debt burden, and it's not doing so. The government thought that nominal GDP growth will remain at 12%. It's not going to be that. And therefore, the tax assumptions, the compensation that the states need to pay, all that needs to be adjusted downward. So interest rates need to fall. What has happened is that while inflation has come down, the real repo rate is averaging 2.5% over the last 5 years. It's even now 2.2%. Even if you build in the 50 basis points of cut which everyone expects in the coming monetary policy meeting, it's still 1.7%. I think there's another maybe 70, 80 basis point after this 50 basis point cut. So there is a significant reduction that can happen even in the repo rate. The term premium, you're right. I mean, it is worth questioning that with 20 basis point potential slippage in the central deficit, do you really want to be talking about a 190 basis point term premium? And I think it's a matter of signaling. It will come down, and then there's also, you must have noticed that a new bond index is going to come up, and that's actually trading at 6.2. But we need to see it in the context of signaling of where interest rates are headed, and if they're appropriately done, I think the 10-year bond yields will come down. And the last segment is the credit spread, which is about the capacity of the banking system and the intentions of the banking system to lend. So what has happened in the last 3-4 months is that the credit spreads have widened as well. So what I'm told is that in the auto market, if 3-4% of the potential borrowers were being rejected, so so you go and buy a car and you apply for a car loan, the loan is available, but earlier 3-4% of the applicants would be rejected. Now 20% of the applicants have been rejected in some markets. So banks have tightened. So basically the credit score at which you will. So this it shows the credit spreads have actually widened, and the same has happened for banks lending to corporates as well. And so this is a financial system capacity problem, which will take some time to adjust. But I think the repo rate and the term premium, I think, can still fall, and they need to fall for us to be able to see lower rates. I think this whole issue about PSBR has been, I think, blown out of proportion, given the quantum of, if it was pure demand supply, and we've discussed this on your show the last time I was there, given the quantum of OMOs purchases that the RBI is doing, it's not about demand supply. I think it's about anchoring. It's about medium-term outlook, a medium-term fiscal outlook, the resolve of the government to stick to its fiscal consolidation path, and all of those, in my view, are indicating that the term premium should be much lower.
All right, so I'm going to ask you one last question. It looked like after this announcement and on the sort of consensus expectation that there's room for another 50-odd basis points in cuts, it looked like we're sort of running out of bullets now. Interest rates are down 110 basis points. If you go down to 5 and you've ruled out any more fiscal stimulus, then what shape does the economy take, say, for the rest of this financial year and next financial year? I'm asking on the basis of those consensus expectations, unless, of course, the repo goes down by another 70 plus 50, like you said. That's a different scenario.
Yeah, so I think rate cuts will continue to happen. And finally, I think the RBI governor has also started talking about it, that there is room for rate cuts. And that's the right signaling, I think, for the bond market. So I also think that, that you see, the problem with economic cycles is that they keep building on themselves. So, as banks become more circumspect, they reduce credit, that slows down demand even more. As companies become more circumspect, they slow down investment even more, and that slows down the economy even more. The government, look at the Telangana budget, right? I mean, the new budget has a 20% lower fiscal spending target than the interim budget presented in February, and primarily because taxes are lower. You look at the GST compensation. I haven't been able to see the new release yet, but the fact that June-July compensation was 28,000 crores means it annualizes to 1.68 lakh crores, whereas the total compensation cess collection is 1,07,000. So you will see fiscal spending cuts as well, I fear. So the economy, I think, will continue to slow. At some point, I think the government will have to, and this is why I've called it the start of meaningful financial reforms. The government now sees the need to do something serious. This one, while there is some criticism about Sud Bud Ki Sarkar and all that, but this one is still not one which requires usage of political capital. I think what we will see, or what we are likely to see in the coming months and quarters, is the government starting to use political capital, in the sense that the equity markets are clearly gone ballistic after this. Maybe they need to do disinvestments to show their resolve for reform, which hurts them politically, but still is better for the economy, better use of funds, and getting large profit-making public sector units in private hands, so that over 2-3 years they start generating more value. So I think these are things that are necessary. As that happens, I think you will see. I mean, the moment you see one large profit-making PSU being sold, you see where the term premium goes. This will also reduce the stress on the fact that the government can't spend. The government spending budget this year was up 21%. What they have, they're growing right now at about 7-8%. That's not, which means that they're really fiscally constrained. If they get the disinvestment funds, I think the ability to spend also will be there, and that will perhaps allow the trough to be created much earlier than it would otherwise. So I do think that more steps are needed. Eventually, I think we need to privatize the PSU banks, or rather at least create incentives for them to start lending and have some benefit from growing their loan books and taking some business risk, which is not there currently. In the current architecture, I think there is a systemic problem with financial system capacity. Those things may happen 9-12 months later, but I think that is when the economy really starts to take off.
All right, we'll leave it at that. Thanks so much, Neelkanth Mishra, for joining us here on Bloomberg Quint, and thanks for watching.